Also with us is a longtime bull turned bear. Right now he's cautious on the market. Joseph Battipaglia of Stifel Nicolaus. His stocks research team was recently ranked #1 by the Wall Street Journal. And Joe, I want to start with you because Dom and I were just chatting a little bit about the stimulus possibilities, or really lack thereof, as far as the commercial real estate sector is concerned. Everybody's been waiting for this shoe to drop, and it looks like it may be on its way or in the process of doing so. But you have a suggestion that would help them out, as well as a lot of others who are deeply in debt.
Well, certainly the commercial real estate industry has been working closely with the banks to try to extend maturities, get favorable covenants, and work their way through the crisis, much less chaotic than what we saw in residential. But overall, the problem is this. There is too much indebtedness for the economy to support itself. And so we need to think about massive write-offs of the credit system, particularly for small businesses and for individuals, to essentially reload the gun for future growth, because spending for spending's sake doesn't work, and it looks like there's no appetite for tax incentives for investment. So we got to face this credit crisis head on.
I just see a giant headline, moral hazard. I mean, isn't that a huge problem here, especially if I've been fiscally disciplined and my neighbor here has been racking up, tens of thousands on his credit card, buying his new Porsche and whatnot? It doesn't seem really fair. I want a Porsche.
Well, what'll happen is that the weaker participants in the market will be swept aside, prices will go to their natural level, and instead of the artificial props that the government has already created in housing and keeping certain banks alive for in perpetuity and creating a whole regulatory framework for too big to fail, we actually have an opportunity to move aside from the overburden of the past and let the real prices show through. You won't be allowing the markets to actually go up, but they actually will go to natural levels and we'll start over. The pain is severe, let me tell you, but it may well allow this economy to start to heal.
So if we don't have another stimulus package, how low do we go? Because it's starting to look like the only reason we were up the past 6 months was because of the stimulus.
Well, bear in mind, there's a couple of factors working to hold us up. The biggest one is that the Federal Reserve is going to be at zero for time to come, and the yield curve is flattening out, lowest rates in memory. At the same time, the consumer has been on their back for several years, and they are showing some signs of life, trying to carry on with existence. After all, time marches on. So these are props for the market. Also, export demand has come up a bit because of the fall in the dollar prior to its rally against the euro, and the fact that capital spending has gone lagging for a time. So these are positive props that keep you from falling into a measurable recession. But let's not forget that even a slow growth economy, which we're in right now, has its own pain. It means employment stays high, housing prices may slip, and it's going to feel awfully difficult for the consumer for the rest of the year.
Joe, it's Dominic here. Even some of the most optimistic traders I've spoken to over the past few weeks have basically said that it's going to be at best range bound for the next 3 to 6 months here. What does it mean for just the average retail investor out there? Should they even play in this market if the best case scenario is to kind of be capped within this certain range, and most people saying that we could be heading more towards the downside here?
Well, there are themes that they can play. One is an ongoing low interest rate environment, and number two, very slow growth without inflation. So what it means is that their portfolio should focus on yield where there's safety attached to it, so the companies can pay their interest or pay their dividends. If it's a global investment you want, then it's a company that is broadly diversified around the globe, who has demonstrated that they can move capital and assets quickly depending upon where they're being treated fairly. So that low yields today, while we don't like them relative to our history, might become attractive to the investors as the years pass, because the deflation threat always lingers when you have this kind of slow growth environment. And if deflation comes, then having dollars and having anything with a sustainable yield is worth that much more to you as each year passes.
Well, what about, let me ask you if it brings out the bear in you to think about long-term interest rates climbing. I mean, from my own perspective as a consumer, the worst thing would be to be in this kind of sort of bumpy recession, called recovery if you want, but it doesn't even feel that way, and then have mortgage rates go up to 7, 8, 9%. That would be horrific.
That's a great point. And that's why I strongly urge investors to ladder their bond portfolios, whether it be corporates or municipals. We, in fact, manage a product that gets at that end. Why do you ladder it? So that you have a lot of your maturities each year, 10% a year over a 10-year ladder. You're reinvesting at the then current interest rate 10 years out. So you're moving with the market. If I'm right and deflation's the challenge, then that portfolio performs well. If I'm wrong and rates move against you, you're going to be moving your portfolio up into higher rates. Either way, I think you're you're hedged properly for what may come down the road, and always getting a yield in an environment where investors are starved for yield. The market had a positive tone through the summer last year, and it kept moving higher into the fall. Analysts were enthusiastic about this supposed V-shaped recovery, so they were raising estimates. Now we're on the other side of that. We're only a couple of quarters into recovery, and there is no V-shaped recovery to be seen. The GDP numbers are falling, not rising, and the market is shading lower as analysts cut their estimates. So it's a very different picture than last year. Even though the volume may be weak, the direction isn't very good.